In October 2025, Meta announced its largest AI data center campus yet, a project expected to cost around $27 billion to build. Meta will use all of the computing power it produces, but Meta only owns 20% of the company building it. This is financial close, and this is how you finance a bet this big without putting all of it on your own books. The project is called Hyperion, in rural Louisiana, more than 4 million square feet, drawing up to 5 gigawatts of power at full build-out, roughly the output of several large power plants. It's the kind of AI infrastructure every hyperscaler is racing to build right now. The question this episode is actually about isn't the size, it's who's paying for it and how. Meta didn't finance Hyperion the way a company usually finances a data center it needs. It formed a joint venture with Blue Owl Capital, a private credit investment firm. Blue Owl owns 80% of that venture. Meta owns 20%. Blue Owl put in roughly $7 billion in cash. Meta contributed the land and construction already underway, and in the same transaction, received a one-time payout of about $3 billion. Here's the part that makes this a financing structure, not just a partnership. Once Hyperion is built, Meta leases the campus back from the venture it only owns a fifth of on an initial 4-year term. And if Meta ever doesn't renew that lease, it has agreed to backstop the asset's value for up to 16 years. Meta gets the compute it needs today. The debt, the construction risk, and 80% of the ownership sit somewhere else, technically outside Meta's own balance sheet. Blue Owl didn't fund its share alone, either. Financing of this size gets raised through the venture itself, sold on to institutional investors, the same kind of investors who buy toll road bonds or power plant debt. So the ultimate money behind the world's biggest AI bet isn't just Meta's cash or even Blue Owl's. It's spread across bond investors betting that Meta's lease payments hold up for years. It's a structure built for a toll road, applied to a data center. Now compare that to what happened when a different AI power deal touched the public grid instead of private capital. Amazon agreed to buy nuclear power directly from Talen Energy's Susquehanna plant, largely bypassing the shared grid. Federal regulators had to approve the interconnection, and in November 2024, FERC rejected it, 2 votes to 1. The regulators' concern: quietly routing power straight from a nuclear plant to one tech company could shift costs and reliability risk onto everyone else still on the grid. Put these 2 stories side by side, and the real story of AI's physical infrastructure comes into focus. When the money is private, bonds, joint ventures, leases, investors are choosing to underwrite that risk with open eyes. When AI's power demand reaches into the shared grid, regulators are the ones asking who absorbs the cost if it doesn't go as planned. Same appetite for power. Very different answer to who's actually on the hook. That's the question this whole series keeps circling back to. We asked a version of it in episode 1, when Chicago sold its parking meters, and it was the public, not the investors, who absorbed the loss. Ownership and risk don't have to match. The deal only makes sense once you know which side of that gap you're standing on. A 20% owner asking for 100% of the output isn't a partnership in the usual sense. It's a financing structure wearing a partnership's name. Whether that structure holds depends on who's really bearing the risk once the leases and the guarantees run out. Subscribe, and I'll see you in the next one.